President Biden setting plans for a trip to Saudi Arabia next month. A decision, a stark contrast to his campaign when he vowed to not visit the, quote, pariah state after the killing of the journalist Jamal Khashoggi. This as oil prices surged to new highs. So what should we expect from this trip? Let's bring in Halima Croft. She's RBC Capital's global head of commodity strategy and a CNBC contributor. What do you expect from this trip? It's going to be more than just about oil. We know that security, missile defense, Yemen,
Absolutely.
Iran, et cetera. But will there be, you think, Halima, any breakthrough with the Crown Prince regarding oil supply?
This is going to be a broad reset in the bilateral relationship. As you mentioned, it's going to encompass, new security guarantees for Saudi Arabia, likely new defense support for Saudi Arabia, potentially new moves in terms of the Israeli-Saudi relationship. But clearly, oil is also at the center of the conversation. And the question is, are we going to see more Saudi barrels coming to the market after they finish unwinding the OPEC cut this summer?
Well, that's the question that we're going to ask you, because they'll say they don't have a lot of spare capacity. What about the declaration of cooperation? What can the Saudis do alone, or maybe with the UAE, the Emirates, to be fair, Halima, that is going to alleviate this supply-demand imbalance that is sending prices through the roof?
Brian, look, we have very little spare capacity left in the system. We probably have, if you do Saudi Arabia and UAE, around 2 million barrels a day. So potentially, do they give more of those barrels to the market? And the question is, if they do so, will you actually see prices come down, or will market participants focus on the fact that we have so little spare capacity when we're going to have this big SPR release winding down in November, and then the European sanctions kicking in at the start of the year? So the question is, if the Saudis do more, will it be enough to cool off the market?
Well, they're going to have, Halima, a lot of people don't realize that the European oil sanctions, to your point, really don't kick in until next year. The SPR sale will be done. It's got to be bought back. Assuming no major global, let's say China then fully reopens, India, they've been cranking. Assuming there's no major global economic slowdown, it's very easy to envision a scenario where oil prices are a lot higher.
Absolutely. And Brian, we are in a situation right now. We've just lost 1 million barrels of Libyan production because of continued unrest in that country. So we do not have spare capacity shock absorbers if we have trouble in any more producers. And I would flag one thing to watch is we're not getting any progress in the Iranian nuclear talks. And there's real concern that these talks could break down and you could have more tension over Iran in the coming weeks.
Halima, just as we look at the energy sector and in terms of the investment, as an analyst that's speaking to some of the biggest investors in the street in this space, what's your sense? We know it's an overweight, but what's your sense in terms of where weightings can go in this sector and some of the technical elements of this? Because at this point, the news flow fundamentally on the bottom up is companies. Look, if you look at some of the resource, the chemical plays, and some of the companies that are buying back their stock and actually raising their payout levels, these are companies that are run very differently than they were years before.
Yeah, again, I'm not an equity analyst, so I don't actually cover the companies. But again, I think that the key thing to be watching, which is an interesting development on the company side, is looking at the new Biden administration posture. You're seeing some Senate Democrats coming out and essentially saying, we wanted you to drill more. We wanted more barrels on the market. But now we're actually talking about taxing windfall profits. So I do think, one interesting development as we think about what's left in the toolkit for the White House to try to bring down prices. It's interesting that they're pivoting now to essentially saying to companies, we're going to tax you. We're going to basically accuse you of price gouging, when previously they had been saying, we want you to produce more barrels on the market.
Halima Croft, RBC Capital Markets. Halima, need your insight. Appreciate you coming on the program. Thank you. Don't roll your eyes. We'll see you at 5 a.m. probably tomorrow as well. Don't sleep at all, Halima. Just stay there in front of the camera. We need you. Karen, the OIH, it's interesting, the oil stock ETF. The last time that oil prices were here, the OIH was $1,000. It's at $300, $275 now. The disconnect is crazy.
It is crazy. And this windfall tax today, I can see why.
Because higher taxes always lead to more output.
Right. Yeah. It just flows.
That was sarcasm.
I got it. I got it.
I don't really get, that seems to be a non-starter. They have to go through all the capital expenditures to increase production that then they're taxed on, and then they're left with potentially excess, infrastructure. If prices go back down, that doesn't seem like very encouraging. It seems obviously like a non-starter, but things like that leave the OIH as a disconnect to the underlying oil price.
Sorry. The things that I harp on with the sector, and I was starting to talk about, so Dow Chemical, so if you look at some of the derivative plays from petroleum, just redeemed, I don't know, a $750 million bond. They've talked about more debt buybacks. They've talked about more and higher payout ratios. Today, you also had the Ham family, who's the majority shareholder in Continental, deciding to take this company private, because they can, and they did it at a level that was attractive, although, there's a lot of other companies that believe that kind of price action and that kind of capital markets activity is in their future. Those are the things that, to me, make energy investable. Those are the things that make this not just a trade. And I think it's fair to say, Dan's pointing out that, hey, it's a crowded trade, and it's been a good trade. I'm not sure this is the time to chase it. I look at the structural things, the things that Halima's talking about on the macro, but the way these companies are run and that they're re-rating, and energy companies right now are very cheap relative to themselves, not just the market.
I just wonder, it's capital-intensive business fueled on debt, higher rates. I'm not sure that's going to be the thing either. That's going to attract
I don't see
more
the same
production
debt
as well.
that we had 5 years ago.
Yeah, and I want to clarify, you said the Ham family, you mean Harold, not John, just to clarify.